right, friends, welcome to you all around the world. Welcome to Follow the Money Radio. So grateful to have you here for this very special episode. As you heard, my name is Jerry Robinson, and today we are delving into a topic that lies at the very heart of financial success, that is investing. We're not just going to be talking about growing your money, but about building wealth that can stand the test of time. And in this episode, where we're going to continue moving through our 5 levels of financial freedom, we've been in a series now for some time, we're going to explore 3 powerful investment strategies as we open up level 4 of our 5 levels of financial freedom that can lead you on the path to financial prosperity. Now, we're going to begin by discussing the art of diversification, spreading your investments across various asset classes, from real estate, stocks, bonds, cryptocurrencies, and more. And then we're going to uncover the key principles that guide successful investors. Then we're going to turn our attention to safeguarding your wealth against the eroding factors of inflation. And we're going to learn how to invest in something we call PACE that can provide a very potent shield, allowing you not just to preserve, but to expand your purchasing power, even in the face of inflation. And then finally, we're going to explore a paradigm shift in how you view cash. Instead of letting it lie idle, we'll delve into strategies that enable you to trade it for cash flow, a steady stream of income that can fund your dreams and aspirations. So if you're ready to take charge of your financial destiny, stay tuned. This episode is packed with actionable insights that can set you on the path to a more prosperous future. Let's dive in. All right, friends, so we do have a great show lined up for you today. Episode number 449, we've entitled today's episode, Investing for Success. And as you know, if you've been listening to some of our recent podcast episodes, we've been going through our 5 levels of financial freedom, which is something that we created many years ago. It's available for free right there on our website, followthemoney.com/5 levels. You can also find the 5 levels of financial freedom written about in my book, Bankruptcy of Our Nation. And as I've explained in previous episodes, this is the exact blueprint that I and my wife have used to break free financially, right? To basically use a step-by-step process to allow us to break free from the rat race. And that's what we're sharing with you today. So we're actually in level 4 of the 5 levels of financial freedom. We just finished level 3 in our last podcast episode. And so today we're going to be moving into level 4, which again is all about investing. Now, we're going to break up level 4 into a couple of episodes because there are several topics that we cover in level 4. Today, we're going to focus upon as we had mentioned earlier, the kind of 3 aspects of level 4 when it comes to investing, diversification, inflation protection when it comes to your investing, and then also trading cash for cash flow. And in a future episode, or on our next episode, we're going to finish or complete level 4 by talking about also the importance of creating multiple streams of income. That's also a level 4 activity. So we'll talk about that on our next episode. But today, we're going to just dive in to level 4, which is all about building and diversifying your investments. Now, you may recall all the way through level 1, level 2, level 3, we have only been focused upon building our financial reserves, saving, creating good habits. And we started a systematic savings plan way back in level 1, you may recall, ideally saving at least 15% of your gross income. And so by the time you get to level 4, you should now have 6 months of your monthly income saved and diversified in liquid assets that will help protect your savings from inflation and also provide you with that emergency reserve and opportunity pool of capital for the days ahead. Now that you have your savings reserve, now that you've gone through level 1, level 2, level 3, you don't want to stop saving 15% of your income. Instead, now, rather than keeping it in liquid savings or putting it into liquid savings, you will now divert your 15% savings every single month into investments, because now you have your 6 months liquidity pools, all filled up. Now it's time to move into investing. Now, Really quick, important note here. If you ever drop below your 6 months of liquid savings, what you'll immediately do is you'll stop adding new money to your investments and you'll replenish the 6 months of savings and then go back and resume adding to your investment pool, right? So you think of two buckets. You have a savings bucket and then you have an investing bucket. Well, you're going to keep that savings bucket full at all times, 6 months liquidity at all times. And when you need to use it, that's okay. You'll just take the money that you save every month, your 15% of your paycheck, and you'll put it back into that savings bucket till it's full, and then you'll go back to your investing. So when you have a full savings bucket, it's time to invest. That's how it works in the 5 levels of financial freedom. And quite frankly, most people find it to be more enjoyable and fun to invest than to save. So this is what many people call the fun part, where they get into the idea of investing. So that's where we're going today. And let's begin by talking about one of the most important concepts when it comes to investing. I mean, I think most of us know, or many of us know, many of the important principles when it comes to investing. Obviously, to get started investing and to get started investing early. The earlier you can invest, the earlier, more of a head start you have, the better off you're going to be, right? So starting early is one of the best ways to build wealth over time when it comes to investing. So too, you want to invest regularly. This is very, very important. It's not just a matter of getting started early. You want to invest regularly. In fact, we did a podcast called The Habit of Investing, or I believe it was a webcast or a podcast we did several months ago. It was extremely popular, and we got a lot of great feedback from it. But you really want to make investing a habit. It's not something that you just do once. It's something that you continually do. It's something that you are. Investors invest, and that's what you want to think about yourself as an investor. And so it's important to invest early, invest regularly. It's also important to invest, enough to meet your goals. So that's important. And obviously you want to have a plan and keep that plan diversified, as we're going to talk about now. So obviously some of the basic principles of investing, very, very important. But today we want to focus on some of the aspects here in level 4. So diversification is the first principle we want to talk about. Diversification is like the foundation of a sturdy financial house. It involves spreading your investments across different types of asset classes. Now, this strategy is key to managing risk and then also improving your overall returns. By avoiding overconcentration in any one area, you're able to potentially enhance the stability of your investment portfolio. And when we speak about diversification, we really think about all of the different asset types or asset classes that we as investors have the opportunity to invest in. So let's explore some of the wide array of asset classes at your disposal. Obviously, one of the most powerful asset classes available to any investor is real estate. Real estate is my personal favorite investment class or asset class. The reason for that is because it's so versatile. Yes, you can take real estate and you can buy it and flip it for capital gains, but you also have the ability to hold it for rental income. So then you can enjoy the property appreciation and the rental income that comes in on a regular basis. You also have incredible tax benefits when it comes to real estate. So real estate is one. This podcast is not just about real estate. We've talked about real estate on previous podcast episodes, but real estate is certainly one of the asset classes that you can focus on and have diversification in. I strongly encourage people to look at real estate as an investment class, and especially when it comes to buying an income property. I'm of the belief that anyone who is able and willing should be able, should go out and buy one piece of income property at some point in their life, at least one. So you have that extra income coming in, another stream of income, and then also capital appreciation along the way. Now, everybody's different though, and so some people that would not work, or it wouldn't, maybe you're in the wrong area. Some places of the country, or it's just impossible to buy an income property because prices are just exorbitantly high. So real estate is ideal, but not always, doesn't always work out for everybody. Stocks are another type of asset that you can invest in, and stocks represent ownership in companies. So this provides opportunities for capital growth and dividend income. So stocks can certainly be another area where you would look at diversifying your investments. Bonds are also another area that many people will look at, and bonds offer a fixed income stream and are often considered safer investments, which is kind of tongue-in-cheek, especially when you consider what has happened to bond prices over the last few years. We've really seen some, the prices get whacked, especially in the wake of rising interest rates. But bonds are yet another asset class that you can look at. There's also commodities. So like oil or gold, these can act as a hedge against inflation. And we're going to talk about that in our second aspect of investing when we talk about inflation hedging. We'll get back to commodities in a little bit. And then there's cryptocurrencies, of course. These are obviously relatively new, but they've shown tremendous potential for growth and are gaining traction as an alternate or alternative asset, on Wall Street. So cryptocurrencies can also be an area where you can diversify. And then, of course, there's business interests, right? You can certainly invest in your own business or someone else's business through venture capital. So there's business interests, and these can be very lucrative for generating income, for you over time. Now, when it comes to, how you should allocate your investments, you really want to consider your risk tolerance. You want to figure out how much risk are you willing to take on. That really is determined by your age many times. There are some rule of thumbs that you can use when it comes to that, but also sometimes those don't even really tell the whole picture, because some people are just more risk averse by nature and others may be a bit less risk averse by nature. Also, you want to consider, speaking of your age, your investment horizon. How long are you going to be investing? That will determine what kind of investments you buy. And then also, what are your financial goals? Your financial goals will also strongly determine what your allocation will be. So there's really no, set it and forget it kind of plan for every single person, because people have different risk tolerances. They have different, time horizons. They have different financial goals. So ultimately, your well-balanced portfolio is going to typically include a mix of various asset classes, a little real estate, little stocks, right? Maybe some bonds, maybe your own business, maybe some commodities, maybe a little crypto here and there. But again, that's all going to be determined based upon your risk tolerance and your time horizon and your goals, right? So these are really what matters. You really want to sit down and figure out what those are. What am I willing to take a risk on? How much do I want to risk? How much of this money could I afford to lose? What are my financial goals? Why am I saving money in the first place? What's the whole point? So you want to have all that, laid out so that you're prepared as you move forward. But, somebody who is very young and just starting out of the workforce, well, obviously he's going to have a higher risk tolerance and a longer time horizon than someone who is nearing retirement, who may need a more conservative blend of assets to make sure that, he or she is not exposed to some sort of dramatic decline at the worst possible time as they near retirement. But ultimately, what we're really saying here when it comes to diversification, the key that we're talking about here is balance. In essence, you don't want to put all your eggs in one basket. You've heard this many times, I'm sure. The diversified approach to investing helps mitigate risk and position your investments for long-term success. This is really, really key. And one of the most important reasons why many people will say, why do you diversify? Why not go all in onto that cryptocurrency, or go all into that penny stock, or go all into that, into real estate? Well, obviously there's all kinds of risks that come with going all in, obviously. And the problem is what if you go all in on the wrong asset class and then the IRS changes the rules, right? This is what many people don't think about. And this is why diversification is very important, especially for the average investor out there. It's important to stay nimble and to be flexible so that if the rules of the game ever change, that you're not caught off guard. And the rules of the game are where? Where can you find the rules of the game when it comes to the financial world here in the United States, for example? You just turn to the U.S. tax code, right? The U.S. tax code tells you exactly how the rules of the game are laid out. So right now, the rules of the game, or the U.S. tax code, greatly favors real estate, right? It greatly favors certain assets. It greatly favors life insurance. It greatly favors trusts. There are certain things that you can do that you'll get great tax advantages and tax deferral and tax-free distributions and all of this. There's some really great ways to do that. But if you're not familiar with all of those, then, A, that's going to be negative. And B, if you are going all in specifically for the tax benefits and then the tax laws change, well, that can kind of get you caught flat-footed. So the key here is to really think through what your goals are and then to diversify across various asset classes to the best of your ability. And right here, before we move on, because I want to move on to inflation protection and talking about our PACE strategy for dealing with inflation. But before we do that, let me just make one quick comment on 401k plans, because we do get quite a few questions about 401ks. And we do like 401k plans. They can be really powerful. By the way, a 401k is not an investment. It's just essentially an account that is regulated by the 401k section of the IRS tax code. So if you have a 401k at work, you are able to contribute pre-tax dollars up to a certain limit. And then if you have a Roth version of the 401k, which we strongly prefer, especially for those who have a longer time horizon, then that would allow you to contribute after-tax dollars up to a certain limit. And then you receive those, obviously, when you get to retirement, you're able to begin taking distributions. Now, when it comes to 401ks, again, we get asked, what do we think about them? We get lots of questions, of course, every month. And one of the questions is, should I max out my 401k or should I even bother with the 401k? The way we approach it is that if you have a 401k at work that you can invest in, that you can put money into and save, well, you want to take advantage. If your employer, for example, offers a match, like say so many employers will offer like a 3% or a 4%, 5% match. Well, in that case, that means that if you put $1 into the 401k as a savings, well, then your company is going to match that, maybe dollar for dollar, whatever their rules are, up to a certain percentage. So if you put 3% in, and then maybe your employer will then match that 3% and put 3%. So in that case, you're just getting free money. So anytime the employer offers a match, then you definitely want to investigate that. That usually becomes very, very advantageous to you, of course. So you would definitely want to take advantage of any employer matched 401k plan that you're eligible for. However, you do want to think twice about contributing in excess of the employer match into your 401k. The reason is because you have many other available retirement savings options that may be more advantageous to you. So again, you could be saving in something else besides that 401k. You could take advantage of the 401k for the match, of course. That's great. That's free money. You might as well get it. But beyond that, you may not want to max out your 401k because remember, unless it's a Roth 401k, then you're just putting all that money into a black box, and then you're going to eventually get it back in distributions when you start taking money out of it. But who knows what the tax rate's going to be, right? Who knows? Nobody knows. And so we don't know. But however, with a Roth version, well, it's going to be tax-free. You're not going to pay any taxes on the gains. You're not going to pay any taxes on the distributions, nothing, because it's all going in after tax. So 401ks are, we've talked about them on previous podcasts before. We do get a lot of questions about them. I like the 401k when it comes to the match, right? They're great tools for that purpose. And if they're a Roth 401k, that's even better. That's fantastic. But if it's just a regular traditional 401k, if it were me personally, I would only contribute up to the match, and then I would look for other savings vehicles to use for the rest of my investing dollars instead of simply maxing out the 401k. I hope that makes sense. And if you have questions about that, always feel free to reach out to us. Many people just don't realize the 401k is a completely government controlled savings tool, for a lack of a better word. It's completely government controlled. And in fact, you'll find this out if you ever try to go collateralize your 401k, right? So let's say you got $50,000 in your 401k, you've saved hard, and maybe now you want to run down to the bank and you're, hey, I got this 401k, it's got $50,000 in it. Can we use it as collateral for a loan? Well, you're going to get laughed out of the bank, right? And why is that the case? Why can't you use your 401k as collateral? You got money in there. There's your name. There's $50,000. It says it's in your 401k. How come that's not collateral for you? Here's a really important lesson. And when it comes to finances, very, very important lesson is that you may have money in that 401k, but until you pay the taxes on that amount, you can't use it as collateral because it technically doesn't belong to you until the taxes have been paid, right? You know that the federal government is on a collision course with all kinds of problems, financial problems and economic problems. So in my opinion, it would be wise to think twice about placing most or all of your retirement savings into a government-controlled asset like the 401k, the traditional 401k. Because again, the taxes are unknown. We don't know what it's going to be. You don't really even control it really until you've paid the taxes. So just keep that in mind. And again, I cannot stress the importance of asking your employer if there is a Roth version, ROTH, if there's a Roth version of the 401k. If you prefer tax-free income in retirement like I do and like most people will and do, then we'll see if you have a Roth 401k. It can be a really great thing for your long-term investing goals and really create a tax-free income in retirement. And don't forget, there are other ways to generate tax-free income in retirement. There's several other ways, and we're going to talk a little bit about that on our next podcast episode when we get into multiple streams of income for level 4. But today, I just wanted to make that important comment on the 401k. All right, we got a lot more to cover here on today's episode. We come back, we're going to talk about the importance of inflation protection, how to protect your purchasing power through investing. And then we're also going to talk about the powerful concept of trading cash for cash flow. Very, very powerful stuff on the other side of this break. We'll see you right back here in just a minute. Hey friends, Jerry Robinson here from Follow the Money Radio. Are you ready to unlock the secrets to financial independence? I invite you to join me for a complimentary 20-minute discovery session. It's your chance to dive deep into our 5 levels of financial freedom and get answers to your burning questions. Together, we'll craft a roadmap to your financial success. Don't miss out on this exclusive opportunity. It's a limited time offer. Visit our website, followthemoney.com/coaching to schedule your free 20-minute session right now. Your financial freedom journey begins today. Hey friends, Jerry Robinson here from Follow the Money Radio. For a limited time, you can enjoy an exclusive 15% discount on all of our premium products and services. From insightful video courses to our books and our membership plans designed for traders and investors, it's all here to supercharge your financial journey. Simply use coupon code 15OFF, that's 15 off, at checkout. Don't miss this chance to elevate your financial knowledge and skills. Visit our website, followthemoney.com today. Your path to financial success just got even more rewarding. Seize the opportunity. Get 15% off all products and services for a limited time. Followthemoney.com. All right, friends, welcome back to one of the longest running podcasts focused upon your personal finances. Follow the Money Radio. Great to have you here. My name is Jerry Robinson. I'm the host, economist, best-selling author of the book Bankruptcy of Our Nation, and founder of followthemoney.com. You can find all kinds of great material there. right there on our website. Now, in this segment, what we're going to do is we're going to continue moving along in the topic of investing for success. We're talking about level 4 of our 5 levels of financial freedom. And now we want to delve into the importance of considering hard assets as a key component of your investment strategy. Why? Because of inflation. You know, protecting your wealth from the erosion caused by inflation really got a lot of attention in 2022. And we saw inflation surge at one point in the month of June, 9% year over year CPI, Consumer Price Index. That was pretty stout. Now, it's certainly been higher in the past, and other countries are faced with higher inflation rates than the United States suffered through in 2022. Countries like Argentina and Venezuela, you know, dealing with really tragic levels of inflation. But even just a moderate level of inflation, say 5, 6, 7, or even 8 or 9%, can really wreak havoc upon a well-laid financial plan. So therefore, in your financial plan, as you're creating it, as you're thinking about the future when it comes to investing and creating your investing strategy, it does become important for you to particularly focus upon how am I going to plug the hole on inflation? How am I going to prevent the eroding factors on money, such as inflation? How are you going to protect yourself? And by the way, inflation, simply put, is the increase in the money supply, the supply of the currency that's being used, in your particular country. In the United States, we use the US dollar. So when the amount of US dollars goes up, whenever the amount of actual money in the system rises, the money supply goes up, well, then you and I, we recognize this as a gradual decrease in the purchasing power of our currency. So over time, we'll notice this. As the amount of money in circulation rises, it leads to an increase in the cost of goods and services, which leads to the diminishing value of your currency, right? So this is a crucial concept to grasp because it underscores the necessity of strategic financial planning with inflation protection in mind. Now, one of the most effective ways to counteract the impact of inflation is by investing in things that are hard assets as opposed to paper, assets only. So when we talk about hard assets, we're talking about tangible, physical items with intrinsic value. Okay, these would be things like real estate that you can touch and you can feel and you can see, precious metals like gold and silver, commodities like oil and agricultural products, right? We can think of a lot of different things. Unlike cash and paper assets, hard assets possess an inherent worth that tends to remain relatively stable over the long term. They can go up and down, of course, and their ability to go up often tends to be a factor or be determined by how bad inflation is, right? So when inflation rises, you'll tend to see these hard assets tend to rise right along with it, which is why they work so well, or they can work well, in protecting you against inflation. Now, several years ago, in an effort to develop our own investment strategy to weather inflation, we designed something known as the PACE investment philosophy. And I talk about it in our book, Bankruptcy of Our Nation. PACE, P-A-C-E, is a simple acronym that stands for P, precious metals, A, agriculture, C, commodities, and E, energy. And one thing that I didn't add to the PACE would be real estate. We could add an R to the end, PACER, and we could add R and it would be real estate. I think that's a great idea. So real estate should also be included in that list. So let's not forget it. But historical data demonstrates that these types of asset classes, agriculture, commodities, energy, precious metals, even real estate, which are known as hard assets, they've performed well during times of inflation. Right? These hard assets are tangible investments that you can physically touch and handle. So what we think is a smart idea is to consider allocating a portion of your portfolio, your investments, towards these types of assets. So you could certainly consider precious metals like gold or silver, which have stood the test of time as stores of value and can act as a financial safe haven during times of economic uncertainty. Now, we're not talking about backing up the truck. We're not talking about putting 100% of your money in gold. Of course, that would not be a smart idea. Again, the rules of the game can change. And plus, gold is not known for providing, incredible amounts of percentage gains on a regular basis. So you definitely have to diversify. But having a little bit of gold in your plan, right, that could make a lot of sense. Or having a little bit of silver in your plan could make a lot of sense, right? Additionally, commodities like agricultural products or energy resources, these can provide diversification for your investment strategy and serve as a hedge against inflation. So these can be very powerful. And then, of course, as I mentioned, real estate. Real estate can also offer potential for appreciation, which it often does, but it also can help you generate rental income, which can really offset the impacts of inflation. So that's very powerful as well. Now, the main thing to remember here is that we're not really sharing the concept of a silver bullet here. You don't want to put all your money into PACE, per se. This is just an aspect or a part of your investment strategy that can help you weather those times of greater inflationary pressures. Remember, a well-balanced investment approach should incorporate a variety of asset classes, including hard assets, right? That'll help you safeguard your wealth and secure your financial future. So definitely want to focus upon inflation protection. Those are the kinds of assets that can really help you in that regard. There's other ones that we could sit down and talk about. We could certainly think about, but for the sake of time, we're going to keep moving on into the next strategy and the third and final strategy for today's broadcast. And that is a very, very powerful concept in investing. And that's known as something that I just simply call trading cash for cash flow. To me, if I had a pile of cash, or if you gave me the opportunity to say, okay, Jerry, here's a big pile of cash, or here's something that's cash, I'll give you cash flow. Like every month I'll give you $1,000 or I'll give you $100,000 lump sum, right? I'll take the $1,000 cash flow. Now, why would I take the $1,000 cash flow? Well, the lump sum, may be nice. The problem is that what am I going to do with that cash? If you give me a big lump of cash, what do I got to do? Am I going to sit on it? Am I going to go bury it in the backyard? No, I've got to go invest it. I got to go put it somewhere, right? Well, then I got to go figure out how to turn it into cash flow. Well, that's the whole thing, is that I would rather have the cash flow. That's the purpose to me of cash. So generating passive income through your investments, it's very powerful. So it's not just about having cash. You can get a bunch of cash, but that's not, now you got to make the cash work for you. Well, this is what we're talking about, trading cash for cash flow. And there are many different types of income, and we're not going to talk about all the different types of income that the IRS recognizes today. But one of the most powerful and one of my favorites, and you've probably heard of it before, we've talked about it before, passive income. Passive income is an income that is taxed at one of the lowest levels, unlike active income, where if you go get W-2 income from your work and you get a W-2, that's like one of the most highest taxed form of income that you can get, right? So if you're trying to get tax benefits from your income, well, one of the ways to do it is to earn passive income. So it's the financial fruit of investments that consistently generates returns. And instead of trading your time for money, you can allow your assets to do some of the heavy lifting. So this creates a steady stream of income that can significantly bolster your financial stability. Now, there's lots of different ways, of course, to do this. There's lots of ways to trade cash for cash flow. And I don't think there's really one perfect answer. Again, I hope you're getting that from today's podcast, is that I'm not sharing with you a silver bullet. We're talking about general principles and general concepts that can really be powerful if you employ them. But you also want to employ them in your own custom way that fits your temperament, your risk profile, your time horizon, right? Your financial goals. So transitioning from cash, thinking in terms of just like getting piles of cash, instead to cash flow mentality is a crucial move in wealth building. So rather than letting your money sit idle, you invest it in assets that have the potential to generate regular income. Now, this could be in the form of, let's just give a few examples here. We could do this in the form of dividends, dividend-paying stocks, right? Dividend-paying stocks are a very popular choice. I like dividends. I like to invest in companies that pay dividends. I particularly like to invest in funds that pay dividends because then I get diversification. And I share a lot of those, those favorite ETFs and funds and stocks, with our members here at Follow the Money. We do a weekly webcast every single Tuesday morning. We talk about different topics, including some of those things that I like to invest in, and we all share, ideas. And so this is a really powerful thing. Dividend paying stocks can really be a popular choice for generating that income, taking cash and generating cash flow. Companies with a strong track record of paying dividends especially can provide a reliable income stream. We like to focus on companies that have been paying a dividend for a long period of time and have been raising their income, which can be very powerful. So too, as we've mentioned also, another way to trade cash for cash flow is if you have a lot of cash on the sidelines, well, one thing to do is to buy real estate, right? Real estate, in particular, rental properties, they offer consistent monthly income. Again, you may have to deal with issues. You may prefer to invest in REITs, real estate investment trusts in the stock market, as opposed to investing in physical real estate if you don't want to mess with all the headaches associated with physical real estate, termites, toilets, and and all the other things that you have to deal with when it comes to physical real estate. But regardless, real estate can be another great way to trade your cash for cash flow. Some people like to do bonds, corporate bonds, municipal bonds. They pay interest at regular intervals. That can be a little risky right now with bond prices falling sharply. But again, when interest rates begin to kind of top out, which we believe they're near that level, and then they begin to go down, bonds are going to go back up, right? So that's another thing to keep in mind. Also, if you have a knack for entrepreneurship, this is a great way to take your cash that's sitting on the sidelines and put it to work in starting a business or helping someone else start a business. And that can be a rewarding way to generate cash flow. I've talked many times about how I took cash that has been on the sidelines and I have either loaned it or I have invested it into small local companies in order to earn a very handsome return. That's a very powerful strategy that you can employ, right? But you just kind of think outside the box. Now remember, the goal here is to turn that stagnant cash into an active participant in your financial journey. Another one that's a really, I think, a powerful one is you can take cash and trade it for cash flow would be an annuity. I mean, the annuity is almost the perfect example of this, where you buy an annuity and then you actually take the cash and you give it to an insurance company, and the insurance company then you can either let it grow in a deferred annuity situation, or if it's a immediate annuity, well, you just trade the cash and you just start getting cash flow automatically every single month. That can be a great, and that's in fact, that's how Social Security works. Social Security is basically an annuity. That's how lottery winners, if you ever hear somebody wins the lottery, they say, well, I either get the lump sum of cash, right? Or I can take an annuity for, for 30 or 40 years of payments and cash flow. So, even lotteries use annuities to distribute cash flow that way. Annuities are very powerful. Now, I don't like all annuities. There's some annuities that I just don't like whatsoever. I don't think anybody should look at some annuity. I mean, some annuities, in my opinion, are just not very good. But I think annuities in general are an awesome concept. They've been around for a long time, and there are really good annuities as well. So, and again, that all depends on your current situation. If you're 30 years old, you're probably not going to run out and buy an annuity, but if you're nearing retirement, you're 55 plus or so, annuities can start making a lot of sense. You can take cash and then transfer the risk of holding that cash, put it into an annuity, and then get a lifetime cash flow or income stream for the rest of your life. I mean, that can be really powerful, or for a period of time, or even for your life and then your spouse's life. I mean, it's really powerful stuff. Today, we have covered some pivotal strategies for building wealth through investments. Let's recap the key takeaways. Number one, and first, we talked about diversification being your ally. Spread your investments across various asset classes, and it'll help you mitigate risk and maximize potential returns. Second, consider hard assets like real estate, precious metals, agriculture, commodities, energy. These can serve as a hedge against inflation, preserving your purchasing power. And then lastly, don't let your cash stagnate. Seek income-producing assets that can generate regular cash flow and contribute to your financial stability. All right. So now it's time to put these insights into practice. It's time to take action and begin implementing these strategies into your financial plan. Remember, the journey to financial prosperity, as I've told you many times, begins with a single step. And for those seeking further guidance or personalized advice, don't hesitate to reach out to us. Our team is here to provide resources and consultations tailored to your financial goals. In fact, if you want to meet and schedule a free discovery session with me to see if I can put you in touch with somebody who can help you, whether it be an estate planning attorney, whether it be a financial advisor, or whether you're looking at just different ways of learning how to create cash flow. We have so many different resources here at Follow the Money. We can kind of point you in the right direction. Just go to followthemoney.com/coaching, book a free 20-minute discovery session with me, and we'll be happy to help you get on the fast track to financial success. And friends, that brings us to the end of today's broadcast. And as always, I'd like to leave you with a final word, this time a timeless piece of wisdom from one of the greatest investors of all time, Warren Buffett, when he said, "The stock market is a device for transferring money from the inpatient to the patient." These words remind us of the virtue of patience in the world of investing. It's often the calm and steady investor who reaps the most rewarding harvest. So resist the urge for hasty decisions and allow your investments the time they need to flourish. Remember, financial success is a journey, not a sprint. With each step, you move closer to achieving your wealth building goals. So you got to stay committed, you got to stay vigilant, and I pray that your financial journey will be one of enduring prosperity. Thanks again for being a part of this episode. Thanks for letting us be a part of your life each and every time we do these podcast episodes. And I want to commend you on your pursuit of financial knowledge. If you've listened to this podcast all the way through, it really is a sign that you are moving somewhere very good. I want to commend you for committing to your financial knowledge, and it's our pleasure to guide you on this path. Until next time, my friends, remember, when you're ready for the truth about the global economy, just follow the money. Have a safe and prosperous rest of your week, and we'll see you right back here next time. Until then, God bless.
Is strictly for informational and educational purposes. It should not be construed as specific investment advice. The views and opinions of our guests and sponsors, including Tom Cloud, are their own and do not necessarily represent the views of FTMDaily.com or Robinson Media Group, LLC. Jerry Robinson does hold an insurance license and at times may offer consulting on life insurance and fixed retirement income products. Follow-up, individualized responses to email or phone requests that involve the rendering of personalized investment advice for compensation will not be made absent compliance with state investment advisor registration requirements or an applicable exemption or exclusion and applicable insurance regulations. Past performance is not indicative of future results. You should be aware of the real risk of loss in following any strategy or investment discussed on the podcast. Remember, never do your financial planning through podcast or radio. It's your money. Be wise. Do your due diligence and always consult a trusted financial professional before making any financial decision.